Hopefully we're going to add some value to you. We're going to share a topic of conversation. I can't believe we've been doing these for 11 months. So this is our 11th one. And it's quite funny. I tell everybody it's the last Thursday of the month club that we hold on the last Thursday of the month. And I go, surely that's self-explanatory. So thank you for all of you that do keep coming through and joining us. Tonight we'll be recording it again. We have in the room a couple of experts in the field. Obviously, you know myself, Shirley Drummond, from the practice. Candid 2020, those of you who don't know, is the website where you'll find these posts, the blogs, the video recordings, some interesting information. So please do go along and have a look at it. We are trying to boost our numbers on social media with Instagram and Facebook and LinkedIn. So please go find us there and like us. That's going to be very helpful for us.
Scan the QR code on your way out. We'll take you directly to our social media pages.
That's Lindsay. Lindsay's been part of our practice for the last 18 months or so, and just recently qualified with a postgraduate diploma in financial planning law. So well done, Lindsay. It's not easy. She is 95% of the way to being a CFP, which then is going to make us really proud. So well done. Lindsay, a financial advisor within the practice. We've got Estelle. You all know Estelle, who passed her RE exam, so which is also an absolute achievement. We've got Lisa at the back, who is writing her RE exam. And she has chosen to do it 3 or 4 days before her birthday. So hopefully she'll get a pass as a best birthday present ever. So then we've got Lisa at the back. We've got a new addition to the team, and that's Portia. Portia, stand up so everybody can see you and hear you and know who you are. So Portia has been here for 1 week and 1 day. And very much part of the family already. So that's Portia, welcome. We have Skeen, obviously, you know, Chef Skeen. And hopefully you've had enough to eat. Please feel free to go and help yourself. There's loads and loads that's there. But we have a head office or support group facilities. We can't do this job alone. There is so much that needs to be learned, understood. It's constantly evolving. So what we do for the Discovery Financial Practice is we have a lot of support that comes through in terms of training, development, etc. Debbie Andre on the risk side. So thanks, Debbie, for giving up your Thursday evening and joining us. And then Tammy. Those of you who have done investments with me will certainly know Tammy. Tammy's our invest specialist that has worked with me since pretty much day one at Discovery. So that's 12 years, 12 years, 13. And very knowledgeable and able to work through the ever-changing landscape of investment. So those are the support that we have. And then tonight, last but not least, we have a man in our midst. Matt Hayward is one of the actuaries from Discovery Invest. He is going to be chatting to you tonight about offshore investments, which is what tonight is all about in the topic. He has been in a brokerage before, so has worked with clients, been in the reinsurance space, and now in the Discovery Invest space, specializing in the invest products and the offering that we have. So he's going to take us through the topic tonight. It's for you to understand. So please stop us. Except for Ian. Ian's going to hold all of his questions to the end, of everybody else, if you have a question, I must say that with respect, Ian, because you'll keep us busy all night and we want to get home.
It's nice, though. It's nice. Come on.
He is nice. But please stop us, because it does need to be interactive and it does need to be, you know, obviously giving you the information as to why you're actually sitting here tonight. Try and make it simple for individuals. What do we look at? We look at Investing 101, I've called it. The long in-depth explanation is on the website. Go find it if you're interested and want to recap on it. Leave your money in your check account. We go into bank products. As soon as we're looking for additional types of investments, we start to make use of our asset managers. We're making use of various asset classes, cash, bonds, property, equity. And within that, we're going up the risk rating and hopefully we're going up the return rating too. What is the risk? The risk is time. Have we got time for the markets to recover before we need to cash it in? Because when we're in the markets, there's volatility. We know there's going to be. So if it's cash we need to pay the bills, we need it to be in a low risk. But if it's cash we're hoping to outperform inflation, we need it to be in high risk. We can argue and debate that over the last 5 years or so, have we really got true value out of the market? And that's a whole different conversation. When we're talking asset classes, we're talking asset managers, we also have the opportunity of looking offshore. So when you're thinking and listening to Matt, please remember this is the basics. We have the wrappers that go around it, the flexible investment, giving you access to the money whenever you need to, holding the money in your personal capacity or in your entity, and then having responsibility for reporting. That's the first wrapper that we have. We have a second wrapper, which is endowments. Those two terms we're going to talk about a lot tonight, and the benefits and the advantages of it. And the last wrapper that we have is your retirement. Tonight, we're talking flexible investments, offshore, and where should we, if we should be putting our money, put our money in it. And with that, I'm going to hand over to Matt, ask the questions. We've got plenty of people in the room that can answer. And thank you, Matt, for joining us.
Thank you, Sharon. So yeah, a lot of new faces. Thank you for having me tonight. I'm really excited to be here and just out here chatting. Investments is something I'm very, very passionate about. So yeah, if I'm going too quickly or anything like that, please just shout. Like a 3-year-old kid on Christmas Day, I just want to open the gifts and get to the fun part. So today I'm just going to take you through why you would want to invest offshore, and then just touch on the products that we offer that allow you to invest offshore, just in the benefits of those products. So I did an analysis earlier in the year, and essentially what I looked at is what does everyone spend their money on? Obviously, a large portion of our expenditure is on our cars, car payments, petrol, going on holidays, the healthcare, the medical aid premiums that we pay, all of the devices, your iPhone, your Apple Watches, your Huawei's, and essentially all of these items that we spend in some instances up to 60% of our income on are all really influenced by global factors. Petrol is obviously the easiest example. We know that petrol is influenced by the rand-dollar exchange rate and the price of oil. Obviously, when the rand gets weaker and the oil price goes up, petrol gets more expensive. I'm sure we've all felt it. And essentially, by investing offshore, it allows us to hedge or protect ourselves against this risk. For those of you that don't know, when actuaries look at investing their money, they look at the liability that we're trying to fund. So I did a very quick analysis earlier in the year and looked at, if I wanted to fund petrol for 24 months, what should I invest in? And I used sort of a handful of items, one of them just being investing in dollars. Another one was investing in a fund of commodities, investing in companies that are exposed to oil price. And what I found the best match to basically fund yourself for petrol was just purely holding dollars. Ignoring the interest and ignoring anything is better than anything else. So that just highlights how important it is to have these global assets in your portfolio. Moving on from there, we can see that investing globally allows you to leverage the foreign exchange trends that we're experiencing. Since 2000, we can see the dollars appreciated 205% against the rand. And what's interesting to note is all of these spikes, we can see that they're during periods of heightened, almost black swan events. So you can see here was the 2000 dot-com bubble / the 9/11 attacks, here global financial crisis, COVID, trade war versus China. And what this basically shows is that a lot of the noise in the rand exchange rate is not necessarily driven by events that happen locally. It's driven by general investor market sentiment from around the world. The rand is essentially an emerging market proxy. So global investors are either saying, no, we want to invest in safe haven, and that's the US dollar, or we want to invest in more risky assets, and that's the rand. And this general sentiment is a large driver of the foreign exchange trends. Looking at the returns, what we looked at is if we invested on the 1st of January 2011 in our global endowment, we would have experienced in rand terms growth of 8% per year. That's ignoring any interest by just holding US dollars. And with the way that our global endowment is structured, none of this return would have been taxable. Over the exact same period, if you invested in cash, you would have only earned a return of 6% per annum. Obviously, this is in the form of interest, so it'd be subject to tax in your hands as an investor. This just really highlights the benefits that you get by investing offshore. Again, breaking down another important reason, the chart on the left here just looks at the equity sector concentration globally in the blue and purple bars versus, South Africa is the blue and purple bars, and global is the gray bars. What we can see is that in South Africa, we're very, very overweight in certain sectors such as basic minerals. We've got a little bit overweight in financial services and consumer cyclical. But what's key is that we're underweight in sectors such as healthcare and technology. And these are sectors that are generally expected to provide superior returns over the coming years. Looking at the pie chart on the right there, we basically looked at the unicorns that there are in the world. This isn't a unicorn the majestic unicorn that the horn coming out of its head. A unicorn is a privately held startup business that's valued at over $1 billion. And what you can see is that less than 0.2% of the unicorns in the world come from South Africa. Why this is important is essentially in South Africa, we only have the same companies to invest in. Companies go through cycles. They go through expansionary phases and contractionary phases. By not having these unicorns, we essentially are forced to invest in companies that once they've reached or gone through the expansionary phase, we don't have another option to look to grow our money. Through these global unicorns, we're able to access them at the start of their growth and sort of take advantage of the growth that we're expecting them to have. So it's just important to understand that by having this continuous stream of new companies being offered to the public globally, it's a great source of profit generation for you as investors. So sort of building on what Shirley mentioned earlier, this is that risk return graph. And just to sort of give you guys some context, investors generally want to be there. This means you're earning the absolute highest returns at the lowest risk. Obviously, there's a trade-off between risk and return, and investors will say there's no such thing as a free lunch. So what generally happens is investments will go like that. The more risk you take on, the higher your expected return. And essentially, we can separate this chart into 4 quadrants, where you've got the high risk and low high return and low risk in the top left, high return, high risk in the top right, low return, high risk in the bottom right, and then low return and low risk in the bottom left. These are the highlighted quadrants are the ones that you want to be in as an investor. No one wants to take on a investment that's got a lot of risk but no expected returns. Obviously, you'd just be better putting your money somewhere else. So looking over the past 15 years, what we did is we did an analysis on a rolling 1-year basis across the CISA categories. So you can see the light blue dots are all the South African assets, purple dots global assets. As you can see, the lowest risk being the SA money market. Then we've got SA multi-asset high equity, so that's your balanced funds. And then SA equity finally in the middle there, having the highest local volatility, but also the highest local return. Then finally, we've got the global assets. What we can see is that the global assets, because they're a little bit higher on the chart, they do provide a higher return, but they offer this higher return at a higher risk. This is because in the short term, there's certain market inefficiencies that take time for the price to stabilize. As I mentioned earlier, the general market sentiment on emerging market is a big driver of this, where you can sometimes see the rand shooting up, and this noise essentially filters through into this chart. But obviously, this is on a 1-year basis. When we invest offshore, we know that we're doing it for a little bit longer than a year. Our global endowment has a term of 5 years. So what we did is we basically did this analysis, but instead of over a rolling 1-year period, we did it over a rolling 5-year period. What you can see is that the volatility or the risk of each of the asset classes reduced significantly. As we would expect, as Shirley mentioned, risk is time. Do we have enough time to sort of accept the volatility inherent in markets? So you can see all of the asset classes reduced volatility, but with global assets, volatility reduced by 65%. What's really interesting to see here is the global assets are pretty much in line with South African equities. This means that the global assets have similar risk characteristics to local assets. So you're not necessarily taking on any more risk when you're investing globally, but we can see because they're so much higher up on the chart, global assets can provide higher returns over long term. This is in part due to the foreign exchange trends that we saw earlier. So moving on to the products that we have at Discovery. So we've got the Global Flexible Investment. This is the product that's available to you, minimum lump sum of $10,000. There's no minimum investment term. You're able to access the money as and when you would like. We've just launched the new Cogent's risk profile funds will now be available on this product. And then obviously all of the taxes and stuff will be in your hands as clients. So you'll have to go to SARS and declare everything. So it can be quite an administrative burden. But the real benefits of the global products come in the form of the lump sum global endowment and the recurring endowment that I'll talk about in a bit. For a lump sum endowment, it's got a minimum investment of $25,000. Obviously, it's quite a lot of money in today's terms with the exchange rate where it is. But this is really the flagship product. We've got the wide range of funds for you to invest in. Shirley and the team obviously do their analysis to make sure that you guys are in the best fund that you can be in. But what's important about the global endowment is that it's structured to be an incredibly efficient investment vehicle. So it's structured to be tax efficient. You only pay 12% tax on any capital gains within your investment. But what even more is that you only pay on the gain in dollars. So essentially any gains from the foreign exchange differences are tax-free in your hands. I've got a slide later that just shows you how much of an impact this has. And again, this endowment is made up of 100 mini contracts. So let's say you give us your lump sum of $100,000. You'll basically have 100 mini contracts just to sort of give you enhanced liquidity. So the benefits, the shared value benefit that we have on our global endowment is currency enhancer. What this currency enhancer does is it effectively allows you to invest at a discount to the current exchange rate. How this works is essentially you will go and exchange your money into dollars. Let's say in this example, you had 500,000 Rand, you exchange it to dollars and you'd invest $27,000. In a normal market, that would grow to 51,000 Rand at the end of 10 years. With Discovery, because we can give you a 5% discount to the exchange rate, you're effectively investing $28,000 in the beginning of the term, which after 10 years grows to $54,000. You can see it's over $2,500 at maturity just from this discount.
Now you're going to explain that all again.
Okay.
Because I'm not sure if everybody got that. Did everybody get it? No, it's all right.
Yeah. So to make the numbers easier, you exchange your rands into dollars. Let's say you've got $10,000 and you'll come and you'll invest the $10,000. What we'll do is we'll calculate a 5% boost based on this $10,000. And this 5% will grow in line with the rest of your investment and it'll pay out to you at the end of the 5 years. Sorry, at the end of the 10 years. Does that sort of?
Essentially, it is.
Yeah, essentially a boost, yes, just to make it a bit more clear. This boost is obviously paid out tax-free to you. And if you guys want to think of it in terms of an administration fee, it basically is the equivalent of 0.5% per annum. So it almost makes this a free product when you account for it in that way. So moving on to the recurring global endowment, this is the product. It's the only global endowment in the country that allows you to contribute on a monthly basis. The minimum contribution to this product is $200 a month. And this product really just highlights that global investing is not necessarily for the ultra high net worth person. $200 a month, although at current exchange rates around 4,000 Rand a month, it's not necessarily, it's much more accessible than you might think. Basically, what happens is the money is debited straight out of your bank account. You don't need to go to SARS and get any, or the Reserve Bank and get any tax clearance or anything like that. It's really simple. You just get, the message, the debit order goes off, and bam, it's out of the country in dollars. And we've obviously just added some new funds to this, but you've got a wide range of funds to choose from. We obviously manage all of the tax and the contributions and stuff like that. And again, it's structured for that tax efficiency. You only pay that 12% CGT on dollar growth. So I just wanted to show you guys a dollar cost averaging example. So this is obviously for a recurring investment. And what you can see is that from February to September, this client was investing $1,000 per month. So you can see at the end of the period, they've invested a total of $8,000. Obviously, the dollar amount, we gave it to you in dollars, but the rand amount will fluctuate every month. So you can see what the rand amount changed to every month based on the exchange rate. And then finally, in the fifth column there, we've got the unit price of the underlying investment in dollar terms. So what you can see is that in March, the unit price, the markets went down 15%. Then in April, the markets went down a further 10%. In May, markets had a bit of a recovery. They're up 10%. Again, in June, up 10%. July, markets down 5%. August, market up 5%. And then in September, the market stays flat. So from this, we can see 9.23, less than 10. So the market is down overall at the end of this period. But what we can see is that the actual value of your investment at the end of the period is $8,361. So the market is down, but you have more than you invested. So you have a positive return. And the effect of this is because when the market is going down with a recurring contribution, you're essentially buying the assets at a discount. And then when the market finally recovers, the recovery sort of amplified because you've now accumulated all of these assets at a discount. So you can see even in rand terms, 157,000 rand versus the 147 that you initially invested over the period. So in rand and dollars, you've made money. If we were to look at investing a lump sum of $8,000 at the beginning of this period, or 144,000 rand at that exchange rate at that time, you can see the total value of that lump sum investment at the end of the period is $7,300. So in this case, the investor would have lost money. And again, in rand terms, would have also been a loss in rand terms. So this just really highlights and illustrates the benefit of having an investment strategy and sticking to it. The markets, they're going to go up and down, but the key is to just remain invested and trust in your strategy. And for those of you that are investing continuously on a monthly basis, it's actually better to have the markets going down because you just end up accumulating all of these assets at a discount. So just bear that in mind. It does take some training to understand, and no one likes to lose money, but just bear that in mind. So in terms of the administration fees across our global solutions, the global flexible investment, there's no initial fees payable, but a flat administration fee of 0.5% per annum. But we do have to have custodian fees. Essentially, we have an independent third party who holds all of the assets, basically to protect your interests. Then on the global lump sum endowment, again, no initial fees payable, but a tiered administration fee starting at 0.575% all the way down to 0.2%. But in this case, there's no custodian fees. And again, for the global recurring endowment, no initial fees, a flat administration fee of up to 1.5% per annum, and no additional custodian or trustee fees applicable in that case. So I briefly mentioned the tax efficiency earlier. We can see that in terms of income tax, the endowment is taxed at a flat 30%, whereas if you tax in your personal capacity, it can be up to 45%. So a really great vehicle for those of you earning higher in the higher tax brackets. In capital gains tax, endowment, again, just taxed at 12%, whereas in your personal capacity, it can be up to 18%. Again, just highlighting the efficiencies. This bar chart over here, what I've done is looked at investing $100,000 and looking at the total tax that you'd pay over a 10-year investment term. So what you can see is in a flexible investment product with the rand-denominated offshore funds, you'd pay a total of just over $12,000 in tax over the 10-year period. If we move you into a local endowment, but you still have the rand-denominated offshore funds, you do end up saving about $2,300, but still paying over $10,000 in tax over the 10 years. Moving one step further and putting that same investment in our global endowment wrapper, you can see you're paying $4,000 worth of tax over 10 years. That's over $5,000 worth of saving from this case here. Ends up being around 75% saved in tax just from from wrapping your investment in the correct vehicle. And then moving on to citrus tax, most of you will probably know this as a state duty. You can see South Africa is much lower than some of the developed markets in terms of how much state duty is levied on their assets. Assets that you have to pay your citrus tax on is your foreign-owned property, your foreign bank accounts, and what's really important for investments is your global share portfolios. So again, looking at an example of how much of an impact wrapping your investment in a global endowment, if we look at someone who had $250,000 invested in the US stocks, if they were to die, they would pay 934,000 Rand in estate duty. By wrapping it in the Discovery Global Endowment, the same exact investment, the same amount, they only paid $200,000, 200,000 Rand in estate duty. So 77% reduction in estate duty payable. Same scenario, just different investment wrapper. Just highlights the importance of making sure everything is done. And obviously, that's why you end up going to Shirley, because she knows all of this stuff and can help you with all of that. Important thing to remember about this is, yes, we have double taxation agreements, but it doesn't protect you from the citrus tax. If, for example, you were to die in France and you have 60% estate duty, you don't get a 40% credit. You still have to pay that 60% because all that SARS will do is just not charge you estate duty on that first 20% because you've already paid for it, but your net result is still paying that 60%. So the double taxation agreements really don't help you in those instances. So our global endowment is designed for simplicity and flexibility. You can see that with a global endowment, you don't need to get an international bull drawn. Say it can cost you up to $10,000 per country. So if you've got a global share portfolio, you've got shares in America, UK, Europe, you're going to obviously need to get a will draft for each of those regions. With a global endowment, that's not the case. If you nominate a beneficiary on the global endowment, you also don't have to pay any executive fees. So that saves you another further 4% in estate costs, essentially. And with the estate duty, unfortunately, it's the exact same as it would be in the normal case. But the key here is that if you nominate a beneficiary, the proceeds of the endowment will go straight to the beneficiary. It won't be paid into your estate. Obviously, if it's paid into your estate, you have to wait for the executor to wind up the estate, and it can be quite a long time for that process to happen. And throughout that whole time, your beneficiaries, your kids, your grandkids, they don't have anything and sort of waiting for that to happen. In terms of the flexibility of the product, we can have multiple owners, beneficiaries, and lives assured. So let's say you and your husband or your wife, you both lives assured. What can happen is whichever one passes away first, the global endowment will stay invested until the last life assured passes. So it just helps in terms of, you don't necessarily need to sell the investment at the worst timing of the market in those sort of instances. I mentioned earlier the global endowment is made up of 100 micro contracts essentially. And that just allows you to take up to 100 withdrawals during the first 5 years. As I mentioned, we've got over 300 funds to choose from. And then in addition to this, we've got the global flexible investment and the recurring global endowment. At Discovery, we try and partner with the best. So we've got a partnership with Ocorion, the trust services company, but over 1,500 staff worldwide. They've got offices in over 20 countries. They've got over 15,000 structures under their administration. This is just a cost-effective international trust and service that we provide for you guys. We can get a freezer trust option at $450 per annum. Freezer trust is essentially a trust that has no assets. What you would then do is nominate it as a beneficiary on your endowment or your dollar life plan. And then if something were to happen to you, pass away, the proceeds would go into the trust and it would be active from there.
Maybe just to highlight here, this would be where you've got a minor child as a beneficiary potential. So obviously that's not first prize because they can't take the funds. That's when a trust would be set up of this nature. So it's not necessarily going to be applicable to your endowment, but if that's your need, we have a solution for that need if that's the need that's in place. First prize is obviously to have the major, anybody over the age of 18 as the beneficiary, and they will then receive the proceeds offshore into their bank account. I'm not sure, Matt's got a slide on it, but we also assist if there isn't a bank account held internationally by the beneficiary. We have a relationship with a Mauritian company that then assists in opening bank accounts for the beneficiaries at that time if they don't have. Ah, there we go. Thanks, Tabby. We had it, but now we have it. But Discovery Bank is open. The beneficiary can open and buy account there.
And
And there we go. Awesome.
And then just sort of expanding on the partnerships that we have. So we've got a partnership with Cogence and BlackRock, as well as Goldman Sachs, and they basically help us with our global portfolios. So for those of you that don't know, BlackRock, I think, is the biggest asset manager in the world, over $9 trillion worth of assets under management. Their total assets under management is, I think, similar to the size of the entire unit trust industry in South Africa. And then Goldman Sachs, they've got just over $2 trillion, I think, assets under management. So basically, we've partnered with some of the biggest and the best global names. In terms of Cogence, we've got 3 risk-profiled multi-asset funds. We've got the conservative portfolio, which uses 25% equity as its baseline. We've got the moderate portfolio, uses 50% equity as its baseline. And then the aggressive portfolio, which has 75% equity allocation as its baseline.
These are typically the funds you would have on your recurring income. So your regular monthly amount going into either a conservative, moderate, aggressive fund.
Yes. Then something new we launched, along with the Cogence launch last year, the partnership with BlackRock has given us access to Aladdin Wealth. And Aladdin Wealth is basically cutting edge technology in the asset management space. It monitors over 1,000, there are 3,000 risk factors on a daily basis. Basically, what it allows advisors to do is to stress test their portfolios. You can see, if I was invested in this, and this, what would it have looked like if a similar event to the 2008 crash happened? What would it look like if something similar to the COVID crash happened? Or, if oil price suddenly shoots up, what will my portfolio do? This software basically allows us to ask those questions and understand the answers. It also gives us, I personally really like this breakdown, you can see what risk factors are present in your portfolio. So let's say you don't necessarily want any foreign exchange risk in your portfolio. You can see how much foreign exchange risk is present in it, and you can optimize for that with this, with the Aladdin Wealth. Essentially just allows advisors to tailor the solutions more to their individual client needs in a much simpler and faster way. Moving on to our global share portfolio funds. These are the funds that are advised by by Goldman Sachs. So we've got the Discovery Global Growth Share Portfolio Fund. This is really, if you are more of an aggressive investor and you want sort of exposure to global companies that are expecting to experience high growth in the coming future, that's the fund that you would use. Then all the way on the right, you've got the Global Income Share Portfolio Fund. This fund invests in companies that pay higher dividends relative to the market. So this is again, it's equity, so it's an aggressive fund, but you're not necessarily relying on capital growth with this fund. You're looking more to earn the dividend income. And then sort of left it for last is the Discovery Global Millennial Share Portfolio Fund. It's quite a niche fund. It's essentially investing in companies that are positioned to leverage the trends of the millennial cohort. Obviously, millennials spend their money a little bit differently to baby boomers and all of that sort of stuff. And these are the companies that essentially are poised to take advantage of that.
Not some money.
Yeah. These funds were previously offered as share portfolios, but now we've offered them as fund versions. There's some benefits to this from a tax perspective, but the big benefit is that these share portfolio funds will remain to qualify for the currency answer. They also now will be available on the recurring endowment if you would want that sort of exposure. And it's just easier for advisors to administer. They don't need to keep a portion of your investment in a unitized fund. The minimums to invest in these share portfolios is lower. They were $100,000 and you could only have one share portfolio in your policy. Now, just the product minimums will apply, so it's either $25,000 or $200 a month, and you could invest in all of them if you really wanted to. And then finally, the last fund that's advised by Goldman Sachs is the Megatrends Fund. And the Megatrends Fund is essentially 4 different trends that Goldman Sachs have identified as being trends that are reshaping the future of the investment world. That's technological advancement, environmental sustainability, future of healthcare, and the new age consumer. Technological advancement is obviously the companies that we're expecting to deliver great technology. Example of this would be NVIDIA with the AI revolution that's sort of going on at the moment. Environmental sustainability, these are companies that are sort of looking at coming up with sustainable solutions to the problems that we're facing, whether that's solar power, sort of green energy, sustainable building materials, those sort of companies. Future of healthcare, you can see AstraZeneca there. These are the companies that are investing lots of money in R&D, hoping to one day cure cancer or something like that. Those sort of companies. And the new age consumer, similar to the Millennial Fund, just trying to take on the companies that are positioned to take advantage of the spending habits of the younger generations. And then finally, we've obviously got over 320 external fund choices available. Just to sort of give you peace of mind, we've got Goldman Sachs, BlackRock, Investec, Prudential, JP Morgan, some really top global managers that will also be available for you guys to invest in. And then just to sort of summarize the investment options available across the products. On the flexible investment, you've got the Cogent's risk profile solutions, as well as a wide range of external funds. On the lump sum, in the recurring global endowment, we've got the Cogent's risk profile solutions, plus now the new share portfolio funds, as well as the global megatrends fund. And then finally, the lump sum global endowment, same as the recurring endowment, except you get the currency enhancer, which gives you that discount to the exchange rate. And we've also got over 320 external investment options available. So just to summarize, why would you want to invest offshore? Globally, you want to protect your lifestyle. You want to capitalize on the foreign exchange trends that you've seen. And we can see that by investing globally, you're not necessarily exposing yourself to any more risk than you would if you were to invest locally. And then in terms of Discovery, we've sort of, I hope you've seen that we offer an incredibly efficient investment vehicle to invest globally. There's obviously significant tax and estate planning benefits. And we really do partner with the best global asset managers and administrators out there. So yeah, that's it from me. I don't know if you want to wrap up or...
Yeah, thank you. Thanks, Matt. I think very well explained and a good overview. Hopefully it's added some value and given some insight on it. But I think, we had a seminar similar to this probably about a year ago, actually, at Sasford, when we chatted around with the economist David Ferro, what should we be looking at? And we had a couple of interesting points in terms of the fluctuation of the rand and dollar that Matt alluded to in his earlier slides. And the question I think that gets asked the most is, well, who should be investing offshore and why? Obviously, Matt's gone through a lot of that. And I think it's very important to know that you can't take all your funds and go investing offshore. That's not practical. However, to look to say that perhaps 25% is a number that gets thrown around. 25 to 30% of your wealth could and should be hedged in an international currency and offshore, giving you protection against the volatility of the rand, giving you access to markets that perhaps we aren't exposed to in the South African Stock Exchange. And I think, to me, the big thing is we have those 3 wrappers. We have the flexible investment. Just for the record, I don't have one investment in a flexible investment because it's not something that I believe actually suits the needs. However, obviously there is, well, I wouldn't have it available in the market. The ones we look at is the lump sum, the dollar endowment, having it available, either South African rands being transferred across into a foreign currency using our currency office and having it then invested in the market offshore. And also funds that are already offshore that are perhaps sitting in bank accounts, perhaps sitting in share portfolios, perhaps sitting in investments that aren't manageable and not being able to be accessed as much. So don't only think of money from here going over, think of money that may already be overseas and could want to be invested in those lump sums. Obviously, we have reserve bank clearance that we need to get. The first million that we look at is, I think she buys drinks for everybody. Sorry. We'll let you take it. How to pull on our heartstrings. Dollar endowment, having it, where was I? Foreign exchange, reserve bank clearance, your R1,000,000, each one of us as a taxpayer, every taxpayer has R1,000,000 discretionary travel allowance that you can utilize on an annual basis. That can be taken off in holidays, spending money overseas, and looking at actually taking the money off. That's a calendar year. So it's opportune if you have the availability of funds to consider doing it in this tax year, doing it again in the next tax year. Any funds above R1,000,000, obviously we go to SARS clearance and get the tax clearance and then take that offshore. Funds offshore can be invested already as well into the lump sum. Why do we do the lump sum? Tax efficiency, giving you beneficiary, no tax reporting in your personal capacity. And then I think very important to me is that it's actually in your hand. On your Discovery app, you see the investment, you're able to know that it's there. It's not in the big blue world out there. Something you can actually see it, and the reporting is done in both rands and dollars there. And then to me, I think probably the best kept secret is the recurring. Giving you access with as little as 5,000 rand a month, getting offshore, and as Manta's very clearly, I love that slide. I think I'm going to be pinching that and adding it to the slides that we use. But certainly giving you access to it. What it does for me personally in that investment is it removes the emotions. It removes the should I take the money now, shouldn't I make me wait for the rand is weak, the rand is strong, no, I don't want to. It's every month on the 25th, the debit order hits and I go, well, sometimes I win and sometimes I lose. And fortunately, when I look at the growth over the period of time, it's substantial. So very much an opportunity to start to look at including in your portfolio and chatting to friends and family in terms of making sure that they're also aware of the benefits of it. And then obviously with our great accolade that we have one slide in terms of that offshore international that we have on the one more slide there. I think if we look at it, we have access to legal. We can actually get additional information with regards to tax, immigration, financial, and so a lot of additional benefits that are available to us with being one of the top 40 brokers in the country on the international offshore space. So knowing that you have a team that's there, tell me what have I left out? And call it a night. Pretty much so. I was like to someone exactly the endowments that we've spoken about. It works and it talks very much to also the estate, not just the taxes, but that's got a beneficial nomination. That spoke about the sites that you own assets and you pass away. The liability that lies on your local executives now let those assets move to beneficiaries who you will nominate. So who you want it to becomes a private investor. Particularly on the festival, sometimes they have to nominate an international program officer. It will cost you a safe limit. So that's what I really love about the endowment section. Assets are over the field until the ranks and start for the vehicle. Should something happen to you, go straight to you. Your estate doesn't have to. And that's what's actually happening. Absolutely. And I think maybe just to also leave on the funds, 320 funds. There's not a hope in hell, but Tammy and I are going to know those 320 funds and where should we invest, etc. It's just not possible. That's on the international, never mind on the local front. So what we do is we have a basket of funds that we look at on an ongoing basis and understand and analyze those. So we don't know all of them. If there is one particular one, we'll do the research and we'll look to see whether or not we should consider adding this basket. But those funds are the ones that we look at, monitor on a regular basis, and obviously have the ability to switch within your investment. So if there is a fund there that there's the opportunity to switch and not stuck in it forever and a day. In terms of that. But I think it's just a great way to, as Discovery, show the world your money. And then just make sure that we can diversify the risk outside of the South African land and it's the best. Lindsay, anything from your side?
No, I don't think so. I think similarly to what Tammy was saying, it's a very effective estate planning tool. Along with the dollar life plan, which we probably discuss in detail in another session, but quite a lot of nice offshore exposure elements to be of that estate.
Dollar lifetime is probably another best unkept secret of on the Discovery platform. So yeah, thanks, Lindsay, very much. A flagship product that we have that's available. Matt, you saved our life. You made it very much easier for Lindsay and I, and Tammy appreciates it. So thank you very much. Interesting to have a man speak of the change, actually. So yeah, thank you very much. We're going to be around to answer questions. Please have another drink and some more food, and go chat around. We will then be answering Ian's questions after that. But any other questions from the floor before we ask? Before we leave, anybody got anything they'd like to ask? Yes.
I'm just still answering it, but it's a bit. I like to say that the entry is a bizarre place entry. It's not random space. You can enter with foreign currency and exit as well. It's exit foreign currency.
The money sitting in a sterling account, in a euro account, can be invested directly from that platform. It doesn't need to be South African funds. And absolutely, funds should not come back to South Africa unless it's absolute emergency. And that's why we talk of the 25%, not having 100% of needing to bring back. So yes, very much paid offshore. Other things. No, come on, I'm trying us in the deep end. It's just invested. Any questions, you're welcome to ask. We'll be around to answer questions and go through it. So thank you very much, Matt. We appreciate it.
Thank you so much. Yeah.
Appreciate it. It's not easy to get here on the last Thursday of the month.